I'm really excited to introduce some of the top voices and names in the industry today. We've got a fantastic panel. It's a great lineup, so thank you all very much for joining us this afternoon. Since this is our 5th annual conference, part of our overall theme is about how the cannabis capital markets have changed over the past 5+ years, and also looking toward the future. We've seen some truly dynamic changes in the industry over the past year. Presumably, things will continue to evolve over the next 5 years as we gaze prospectively toward the future and perhaps use the past 5 years as a bit of a guide and touchstone to look backwards and use this for today's discussion. We'll try to reserve about 5 to 10 minutes at the end for questions from the audience. We'll see how we do here. So it's been an interesting year so far for cannabis capital markets. The market was running pretty hot in Q1 with a flood of capital and high valuations, and then it started to level off more recently. Let's do a brief round of intros to kick things off. I'll introduce each one of our panelists, and then after that, I'll have them in their own voice give some of their background and share any information about their firm. So first we have David Bunzell, Managing Director from Young America Capital. Joining us remotely, we have Herschel Gerson, Managing Director and Co-Head of the Consumer Investment Banking at Roth Capital Partners. Matt Hawkins, Founder and Managing Principal of Entourage Effect Capital. Next, we have Morgan Paxia, Managing Partner at Poseidon. Andrew Yeager, I'm sorry, I skipped over you, Andrew. Principal at Cannabis Co-op Fund. And at the end of the row, we have Bill Schreier, COO and Principal at Credit Force. Let's go snake style, starting with Bill Schreier at the end.
Thanks, Max. Appreciate it, everybody. Bill Schreier. I have a long background in the finance industry, all sorts of transactions, public, private, over many years. Fairly new to the cannabis industry, only about 3 years or so, and learning quite a bit about it from the financing point of view. Work for Credit Force, as many of you are familiar with it. Credit Force is an independent merchant bank with several different lines of business. We do some early stage equity investing, both passive as well as active, where we take an active role. We're involved in some delivery businesses. One of our most important subsidiaries is KindTap. You heard about that this morning from Kathy, my colleague Kathy, and KindTap is one of the very first traditional consumer credit cards and loyalty programs being launched as we speak here today for the cannabis industry, for retail cannabis. And then lastly, I represent the asset management portion of our firm, and principally the operation of asset management is senior secured lending. We do lending facilities to cannabis businesses, be it retail, be it cultivation, or vertically integrated businesses. It's typically senior secured lending secured by either real estate or the equipment.
Thanks. Next, we have Morgan.
Good afternoon, everybody. Morgan Paxia, co-founder of Poseidon. We started Poseidon back in 2013, founded by myself and my sister Emily, who I'm sure many of you know more than you know me. So sometimes they let me go on the road. But we started Poseidon with the idea of building an institutional asset management firm when there wasn't such a thing really in cannabis. I mean, the idea of cannabis as an industry was still in its formative years. We actually think of the start of the legal investable industry when we opened our first fund in 2014. We now run a series of private funds and numerous SPVs. Our firm recently became an SEC registered investment advisor, and we're now in the quiet period of our ETF that's coming out in the next several weeks. So we're very excited about the continued growth and normalization of an emerging industry with more and more institutional capital, that's trickling into the space. And our goal is to continue offering good services and products for our investors and the industry, as long as we continue to see the rich investment returns that I think we're all attracted here to do. Still feels like it's very, very early days in cannabis. So thank you all again.
Next up, Andrew.
Andrew Yeager, appreciate it, thank you. I am the microdose of the group, I do believe. We started out as a private wealth management firm, sold off an entity, and became more of a family office manager when a couple of our family offices received licenses. Then we helped them raise equity and debt. And then we launched recently the Cannabis Co-op Fund to hand-in-hand help early stage cannabis companies or those that were looking at joint ventures, either with our family offices or standalones as we made those relationships. And we're exploring other creative structures to help social equity and others access capital through hopefully more public and more cohesive markets instead of just all private dollars. And we'll make about $5 million to $10 million in commitments this year.
Thank you.
Yep.
Matt, you're up.
Hi, everybody. Matt Hawkins. I'm the founder, managing partner of Entourage Effect Capital. We've been investing in the cannabis space since 2014. We're now on our third fund, and like Morgan, a whole host of special purpose entities. We've made over 70 investments to date, and we invest up and down the value chain. We're now investing more in later stage companies, and we're excited to be here, excited to be investing at this time because it is as Morgan said, it's still very, very early, but we feel like we're on the periphery of something that's going to be transformational for the industry.
Thanks, Matt. David?
Thank you, and thank you to Frank and Scott for the invitation to speak, and to all the Burns Levinson folks for all their help. My name is David Bunzell. I'm with Young America Capital. We're based in Mamaroneck, New York, just north of New York City. I've been an investor for almost my entire career till I met the chairman of the firm at a cannabis conference where I was a private investor in the space putting together syndicates to invest, and he said, why don't you get your banking license and you can start getting thank you checks instead of thank you lunches. And the rest is history, as they say. We've done multiple transactions, mostly in the Northeast where I focus, but across the country. We have 70 bankers spread out everywhere. We've got about 20 people on our cannabis team. We've executed probably over 40 transactions as a firm. And my partner Valerie and I tend to focus on the limited license Northeast states. We've done 4 transactions in Florida, multiple transactions in Pennsylvania, Massachusetts, and everything in between. And we have active mandates in all those states, as well as others that we're very active on. And thanks for having me.
Thanks, David. Last but certainly not least, Herschel.
Hey, thank you very much for having me. Sorry I couldn't be there in person. Herschel Gerson, co-head of consumer and lead the cannabis effort at Roth Capital. Got into cannabis in 2019 when me and a number of gentlemen formed LO Capital. We merged LO into Roth at the end of last year. We've been focused, as I said, on the industry for about 2 years, do M&A advisory, private placement, active mandates across each of those service lines, and then as well as work with a number of SPACs, advising SPACs, raising SPACs, as well as advising companies that are doing transactions with SPACs. So thank you again for having me and look forward to the discussion.
Thanks, Herschel. Thanks all. So with that, the first topic of the day is raising capital in the cannabis space. Matt, why don't we kick it off with you? You mentioned you founded Entourage in 2014. It's one of the first cannabis-focused funds in the industry. You've had a long and highly successful history since your launch and debut. Talk to us about how it all began when you decided to take the plunge into the cannabis space through present, and which I understand you're raising your third fund at present right now.
So back in 2014, the industry was very, very young and immature, and we were making, back then, $500,000 checks could move the needle with, they were basically, pardon the pun, but seed stage investments. But that's where we were as an industry. Our second fund was more Series A investments that were $3 to $5 million over the life of an investment. And again, that's just where the industry was, and you were able to underwrite companies basically just on their revenues, but no real earnings. Our third fund's a little different in that the next step of maturation in the industry has been now you can actually find companies with some critical mass at the top line that also are either about to have earnings or already do so. And so we're able to, I come from a private equity background, so we're able to underwrite these companies the way we would, widget companies back, prior to cannabis. And so that makes it, from an underwrite standpoint, a little bit easier, and I think it also removes some of the risk for investors, but the reward is still there because of what's coming, and that's some type of legalization that will bring with that an influx of tens of billions of dollars to institutional capital that's just chomping at the bit to get into this game. Because right now, as everybody on this panel knows, it's really just 90 to 99% high net worth individuals and family offices that are supporting this industry, and there's just not enough of it.
Thanks, Matt. Morgan, you started Poseidon with your sister, as you mentioned, back in I think about 2013, which was a lifetime ago in cannabis years. It's also now one of the longest run funds in the space. How have your investments and strategies really evolved over time?
Every fund we do is, we really take a lot of time looking at the landscape. When we started our first strategy, it was complete white space. And so we went with an approach of a very deep portfolio and just trying to focus on essential building blocks because that's all there was. There was a lot of forced adoption of products just because, again, that's all there was, and people they're trying to grow businesses. They needed solutions to do that. They needed licenses. Very, very primitive. And so as a result, low loss ratios. And, as we fast forward to today, it's the opposite, really, in that, it's a lot more competitive. You do get the benefit of a heck of a lot more information. There's a lot of analyst coverage. There's a lot of eyeballs. People are talking about this. There's tons of exits. You've got comps. You have a lot more of the fundamental pieces when you're looking at companies and you're thinking about portfolio construction and return profiles. In those early days, we just were, building a spaceship as it was taking off and just believing that this industry would take shape and trying to corral capital and point it in a good direction that we thought could help build a legitimate long-term industry for generations to come. And at that time there was no idea of sectors, so we broke the industry down into different areas and tried to explore a lot of different areas. So it was a lot of fun in those early days from the perspective of who knew what would happen. But we always tried to focus on doing what was right for our investors, trying to be transparent, providing shared experiences, creating investor days, things that can bring in people into the mix because, as we all know, the investor base is the high net worth and family office investor. So giving a little more tangible feel to it was a lot of value creation, I think. And so, but boy, is it different today.
Thanks, Morgan. Let's move to the debt side of the ledger with Bill and Andrew. Bill, as Frank discussed with Zach from Sundial earlier today during the keynote, we're seeing more debt flowing into the space. Established debt players have been circling but haven't yet fully committed yet. Talk about, with respect to the Safe Banking Act looming on the horizon, what you see the impact will be as more established players enter the space. And with respect to the Credit Force platform, why now?
Yeah, well, certainly there's a distinct lack of debt capital available to the operators in this space. I don't see that changing very quickly. It's a very gradual process. It will take some time. There's a variety of sources of that capital. It tends typically to be institutional, and we have both internal and external sources of capital that we draw upon in order to make loans to various operators in the industry. But I think at this point, because of sort of the conservative nature of senior secured capital, we're sticking only to senior secured type of loans. Gradually and eventually, we'll move more towards cash flow type loans and other types of debt financing. But at the moment, I think the real preponderance of capital that's available tends to be senior secured. And over time, that will begin to, I think, evolve as we go forward.
Thanks, Bill. Andrew, similar question for you. Talk about your strategy and investment approach and how you think that kind of these looming changes with respect to the Safe Banking Act and established players entering the space, how that might impact what you guys are doing.
Yeah, so we've gradually started to take the step out of the traditional senior secured, though that's primarily what the foundation of our portfolio is. And we've started to match cash flows and expand as balance sheet and cash flows start to expand with emerging companies. So we've taken on more of a cooperative role with our investment partners and those that need capital in the space and really trying to grow with them than being a strict credit lender, so to speak. We do provide access to capital for early stage, non-performing companies that do have other types of secured assets other than real estate. We prefer not to have commercial real estate as a part of the collateral basis. So we're gradually starting to move in that direction to try to evolve to bring access and more capital to those that need it in the space. As it goes for the Safe Banking Act, it's really just kind of creating an opportunity for all of us that are currently in the space to evolve over time. But as I think most of the partners in the panel will agree, it's going to be a very slow go. So I think it creates a great opportunity for us to evolve and make the industry more mature over time. And we certainly want to create as much capital as we can under those terms.
Absolutely. Thanks, Andrew. Opening it up to the whole panel, one of the major questions on I think a lot of folks in the audience minds is, what are some of the key criteria you look at when considering making an investment or making a deal? And anyone from the panel can jump in and answer.
Well, I know for us, it's always driven by the quality of the management team. We've been operators before. We prefer not to be because what we're seeing now is more so than we've seen in the past is that there's more quality operators in the space now than there ever has been. You're getting people from all walks of life and professions that are now experienced, seasoned executives that are looking to make their play into the cannabis space, and that makes our job a lot easier. But our investment thesis is typically large minority positions with board seats or advisory seats with a lot of belts and suspenders on protectionism from the investment standpoint. But again, backing the management teams is what's the most critical thing.
Thanks, Matt. Jumping into the current M&A landscape in the cannabis industry, capital has been flowing into the space, and we've seen a number of significant deals over this year and over the past few months in particular, both in volume and dollar values. David, Young America Capital was one of the first investment banks to enter the cannabis industry. I know you've been really active. Tell us about some of the recent transactions you've been involved in, and where do you see everything going from here? Along those lines, it would be helpful to hear about multiples, what valuation models you're seeing now versus over the past few years, if that's changed at all, and where capital is coming from generally.
Okay. So the M&A market continues to be extremely robust. We've never been busier. We just closed a very large transaction in the last couple of weeks in the Northeast state. And I would say there's no shortage of opportunities. It just comes down to the state that you're dealing in and not only the quality of the management team, but supply and demand of the licenses. Places like Florida, places like Pennsylvania, places like New York, New Jersey. There's just not a lot of operators to choose from, and there's very few independents left. So if you want in, it's a very competitive process and a very robust process. Multiples have kind of shifted from looking at revenue as companies have matured and started to generate EBITDA into more of an EBITDA transaction. Sweet spots in the 6 to 8 times realm, but and then we arm wrestle over whether it's forward or current or trailing. But I would say that seems to be kind of the anchor of most transactions. But then again, if you've got an asset for sale in Maryland or some of these other very limited licensed states, we just went through a very robust process in New Jersey that ended up with an extremely high multiple of EBITDA. So it comes down to this, what you're selling.
And big question: how would you characterize the nature of the acquirers these days? Is that changing?
Slowly, but for the most part, it's those that have the funds. I think Matt touched on this. There's still 99.999% of the world's capital out there that can't touch the cannabis space. So we're pretty much limited to larger MSOs who are much better funded, a lot of the public guys, even the private guys. And I personally think a bell went off with the Scott's transaction and Riv just last month. And so I think we're going to start to see the entrance of quite a few other folks in a creative way until we get descheduling and legalization. So I expect the M&A process, although there's been cycles, we had a very busy spring, everybody kind of digested over the last couple months. But right now, things are starting to pick up quite a bit in your traditional MSO channels. So everyone's trying to round out their footprint and find a partner. So good for us.
Absolutely. Herschel, did you have anything to add along those lines?
Yeah, I would say at the beginning of the year when the administration changeover, we saw a run-up in share price and a lot of the MSOs taking advantage of the capital markets and putting a lot of cash on the balance sheet. So if you look at the MSO, I think there's over $1 billion of cash in aggregate, and they are, they're looking, and I would agree, they're looking at limited license states because generally those states are carrying 50, 60% EBITDA margins, whereas more competitive states like Colorado and California are 20% or below margin. So for every dollar you spend, you essentially get 50 cents in the East Coast versus 20 cents on the West Coast. I'd agree on multiples, really dependent on the market and also the structure of the market. So in Massachusetts, you're seeing a drop in multiples. A lot of that is from the regulatory standpoint that you can't operate more than 3 recreational licenses in that state. And most of the MSOs who are coming in and spending already are at the 3 cap. So there's just not as much capital coming in there or available there to do M&A. But then you're looking at a state like Michigan where it's still predominantly independent operated, and really we haven't seen the MSOs come in other than the recent Gage and TerraSend transactions. So we're seeing that as kind of a fertile area to start getting the MSOs. But the other thing I would say is those oligopoly states, as we look at 2022, 2023, and it gets more competitive in those Pennsylvania and Massachusetts markets, our thesis is that brands are going to start creating some differentiation in those markets. So I wouldn't be surprised as we go into next year where some of the larger MSOs are really trying to beef up their brands, in-house brands, or how they go to market in order to get some pull into those stores and over-index through brands.
I'd like to stay with a thread, Herschel, that you just brought up. When Frank met with Commissioner Hoffman earlier today during his fireside chat, one key point, to me anyway, of their discussion was about saturation or oversaturation of the market here in Massachusetts. I know each market is clearly different, has different regulations, but I'd like to have the panel chime in on their perspective and what impact it might have, with respect to either now or down the road, with the market becoming either saturated or oversaturated. It's a question I'm hearing more and more, so I'd love to get your perspective.
So I'll kick it off. Sorry, I can't see everybody, so I'll kick it off. We're representing 3 parties now in the Massachusetts market that are looking at doing various transactions. As I mentioned, I mean, the one good thing about the cap on the 3 dispensaries, you can do 3 recreational and then 3 medical. So people are trading some medical sites to recreational based on location. That the MSOs just frankly get capped out. So you're getting some more diversification in the players that are operating in the state. But at the same time, we're, at least what I'm seeing is some supply chain challenges, meaning that you're going to have to get a good wholesale market in Massachusetts so everybody could put product on the shelves. And it's hard to find the capital to get the cultivation where it needs to be to supply the market in a way that where everybody can really participate. The MSOs have a lot of cash, so they're easier to get the cultivation and supply chain going. Whereas the third parties are really going to need some third-party capital to come in and develop the supply chain.
I'll jump in, coming from California, to talk about saturation. 2 things that come to mind are price and balance. And what I mean by that is when I'm talking about price, I'm talking about a wholesale price of flower. That is a clear indicator of where the supply-demand balances are. I think prices have come down a little bit. in Massachusetts, right? Nothing like an open market scheme where prices can be vastly lower. So sure, there is more supply coming, but there's still more and more retail opening. So I still see Massachusetts as a nicely balanced market. Just like a lot of markets that are, where the MSOs love to play, right? This is how they get their nice gross margins, how they get their healthy EBITDA margins, and still a lot of top line growth annually. But when we look at other markets, Canada was mentioned earlier quite a bit. Talk about the most unbalanced market, right? I mean, there still is enough cultivation capacity to feed every man, woman, and child in Canada, probably plus Europe and South America, and so on and so on. So that's structurally broken, right? And they need to get that back into balance to get better pricing. So those are two key factors that we look at from saturation. And I think there still is a lot of penetration to go, even when we have these short-term aberrations, which can be incredibly painful and cause pretty large extinction events for operators that get overexposed. We are still talking about addressing our largest competitor being the illicit market, right? And there is still so much to go in that aspect in every single market around the world. So, while we may get over our skis temporarily, I mean, there's still years and years of just penetrating that, let alone new form factors, new markets, new ways of addressing new consumer wellness needs, or even potentially longer tail being, true medicinal capabilities.
Yeah, I think that Morgan's spot on. But the other thing about from an investor standpoint is the limited license states are, for the most part, more attractive to the investors because those licenses are really worth something at that point. And not only that, but the operators that spent their own time, money, effort to get those licenses, you're really aligned with those operators. And that's part of the moat that's created, which is great about cannabis, is that there is a moat because of the regulatory aspect of this business. In California, I mean, it's almost limited licensing because the biggest competitor is the illicit market. And so the more the state of California can get to help get that illicit market tamped down, then the better news is going to be for the existing operators. I would say, again, from an investor standpoint, in California at this point, we're just looking for vertically integrated players that have a chance to take that next step. I can't imagine investing right now in a startup licensee in the state of California would keep me up at night, just would give me heartburn. So
to bring it back to Mass, as long as you're wholesaling $4,000 pounds, I just don't see the peak yet, or the over the peak. And don't forget, we're just 3 or 4 months past 4 or 5 major transactions in the state, with a few more still brewing from that time period. So while there may be a little bit of indigestion from that flurry of frenzy, I don't see it. The only people that say Mass has peaked are those that aren't here yet and talking their book and trying to get in the state from my perspective. So I still see Mass as a very healthy market, although starting to get rationalized just because there's no rec bump on the horizon. It's already here, thank God. Already happened. So Mass is still a fantastic state and still on the radar for quite a few folks.
Anything else from our panel before we move on? So it's no secret, as we've touched upon, that 2021 has been a record year in many ways for the U.S. cannabis M&A activity, and a robust year for U.S. capital raises as well. What do you think is driving investor interest back into cannabis with significant year-over-year increase? The pandemic is probably a huge factor, but what other factors are you guys seeing?
I think we're, as a society, starting to overcome some of the faux pas. As the previous panel obviously pointed out, there's still a lot of lack of education within the system, but ultimately, the risk an investor is willing to take is based on whatever their previous knowledge is or whatever their risk appetite is. So I think as you start to see the more mature markets start to pull along some of those others that are kind of lagging behind, I think you're going to start to see much more influx of capital, and we're just hoping to get it from other sources other than just institutional money and family offices, which once you make it mainstream, then it becomes obviously society accepts it, and you start to get over those educational humps, and you don't have those hurdles anymore.
And lower valuations too.
Much lower valuations.
You know, it's interesting about valuations and just thinking about 21 and thinking about how almost every year that we've been doing this, we go through these cycles where you get these massive multiple expansions and then massive multiple contractions. And it's just wild to see these gyrations because of the lack of institutional capital, right? You know, I think one of the most quoted reports is Jeffries, where they noted that the institutional ownership in plant-touching assets is something like 3% in the United States, extremely low. And, you know, it's usually, what, in excess of 70%, which is obviously very attractive for when that comes in. Much more capital should mean more stabilization around valuations, and also probably much more interesting for all of us that are investing today. But the other thing that's, you know, it's just wild because the underlying fundamental companies are still going forward. They're not stopping their business. They're, you know, as we all talk about, M&A is a massive theme that's going to continue on. We're just the beginning, still highly fragmented industry. And so the fund, you know, looking at it today, I mean, you could argue that, you know, cheap, I know doesn't always mean it's a buy, but there's some great companies that are trading at unbelievable prices. I mean, you know, if you think even longer than 3 to 5 years from now, it's like, you know, excuse my French, but holy shit, like there's a lot of money to be made for anyone that has any kind of horizon. So I'm just really excited about this. And I know people, you know, they pointed to margin compression, they pointed to growth slowing, but, you know, you go from an industry growing at 40% to 20%. I mean, 20% compound annual growth rate for years to come is still phenomenal. You go from, you know, 60s to, you know, maybe 50s and maybe 40s of gross margin, and you still have EBITDA margins potentially in the 30s or 20s. I mean, that still is, you know, beating the hell out of so many other industries that can't even compete with that kind of growth or those kind of margins, and we get them both. So, you know, it's when we just go through these cycles, I just, you know, obviously get very excited when we're getting to the low points of the on the equity side, and I just, you know, as a contrarian, you know, when companies are able to raise debt at very attractive rates because their equity is expensive, equity looks really attractive from an investor standpoint. It's like that complete opposite. If you think back to earlier this year when, you know, EBITDA multiples and price to sales multiples were almost, you know, 2x where they are in some instances today, all they were doing was raising equity, right? I mean, so it's like you can kind of follow these trends year in and year out, and we know that will change eventually when the institutional dam breaks, but for right now, we just kind of live a Groundhog Day while the companies just get bigger, stronger, smarter, and we all just keep learning.
But I would think even as the market institutionalizes, you're still going to have tremendous volatility. You have it today in technology, biotech, electric vehicles, you know, student body left, student body right. You know, it's true. It's not just in retail and hedge funds. Even the larger institutional investors will shift around because their underlying constituents shift around. So you're still going to have probably pretty significant volatility in the equity prices, whether both private or public, even as the market institutionalizes, because it's the nature of equity and equity investing is a lot of, you know, toing and froing.
I think that's true, but the big difference is the liquidity that's going to be there.
Yeah.
That's just non-existent right now. I mean, that's part of the problem is, I mean, Morgan and I, you know, back when the CSE opened up and we had private assets sold to companies that were listed on the CSE because they could allow for U.S.-owned assets, it was a complete pain in the ass trying to set up a Canadian brokerage account to try to liquidate our holdings. And it took us, I mean, you can't just go and sell, you know, more than a few thousand shares at a time in some of these companies. And so that's what's going to be amazing is that when you either have an exit to public companies, or in Morgan's case where they're doing an ETF, or you do a PIPE with a public company, when institutional capital comes in, the liquidity is going to be there regardless of what price you're in at to transact on a buy or sell.
Yeah, hopefully that speeds
I
up
mean-
the whole transaction process,
Yeah,
right? You know,
And
it's,
to some degree, liquidity is a function of how much capital there is available.
That's 100%.
Of course,
That's kind of what I
course.
mean,
Yeah,
right? And because right now it's just not there, and all you have is retail investors that get
Correct.
spooked and get out, and
Right.
it's problematic.
Yeah, some of these stocks trade by appointment, essentially. You can't trade them if you wanted to.
Yeah, just from a public market perspective, I mean, one of the good things about a lot of these companies being public is, we're getting projections and companies now, or estimates, and the companies meeting or beating estimates on a pretty regular basis. So the industry is starting to perform. If we look back at 2019, we were all worried about when companies are going to hit a wall because they're all, cash flowing negative or negative EBITDA now. Surely some of the larger the large companies are doing, 200-300 million of EBITDA. So it's a real industry now. It's employing a lot of people in a lot of states. So the stroke of the pen risk, I think, is muted now. And I think a lot of the market, as administration was changing over, we had expectations of great things with safe banking, safe harbor, federal legalization. I think we're seeing still a stagnant Congress. I mean, we can't get infrastructure done. And you saw even as Schumer introduced his bill, we didn't see a lot of movement in public stocks because I think people are still, a little bit skeptical as to how quickly Congress is really going to act to open up the markets. But as we talk to cannabis companies right now, they're all gearing up to go public, and as they go public, just as we look at the next capital formation events, I think the days of the RTO are over. Companies are kind of filing with the SEC. Ascend was the first, but there's a lot behind them that are going to file S1s and kind of go public through the OTC and CSE through U.S. Entities versus having this foreign private issuer status and kind of doing the RTO. So we're excited about the market, and we think, as soon as the NASDAQ and NYSE opens up, there's going to be obviously a big flood of institutional capital coming in.
Sticking with the topic of SPACs, there's been a lot of public buzz generated about SPACs with Shaq, Jay-Z's cannabis company, and others. Herschel, Roth Capital is well known in the space. Can you help demystify SPACs for those of us who have heard of them but don't have a great grasp of what in reality they do? Asking for a friend, of course, and anyone else on the panel can then feel free to chime in after.
Sure. So look, there was a big euphoria, the golden moment of SPACs at the beginning of the year. And then we've seen some waning related to disclosures on warrants, and then just capital becoming a little bit more tighter to fund SPACs. So essentially what SPACs are escrowed capital funds that sit in a public vehicle. So that vehicle can either be listed on NASDAQ or the CSE, and they have a clear defined end market that they're supposed to deploy that capital. The capital is in escrow, and all the investors that put in the initial capital receive a share in that company as well as a warrant, which gives them the option to purchase additional shares, generally at a 15% premium. Upon the announcement of a transaction by the SPAC, those individual investors all have the right to either redeem their shares and get their cash back or approve the transaction. So if you see a $200 million vehicle, at the beginning of the year, redemption rate sat at 25% or less. So meaning a $200 million vehicle would be about 160 or 150 million of the end funds after all the redemption. Today, we're seeing redemptions 50 to 75%, meaning a $200 million vehicle, really you can only depend on about 50 to 75 million of folks that are willing to kind of stay in, fundamental investors. And that can change based on the sponsor of the fund. And it gets really complicated, or a little complicated related to those sponsor of the fund. They generally, and when you hear a lot of whispers about dilution, the sponsors of the fund, generally for putting up a minimal amount of capital, get roughly 20% of the overall fund. So that changes depending on the fund.
I think that's probably the most important factor right there is the SPAC math. It's got to work, and it doesn't work for a lot of companies, but it works for some. And in terms of cannabis also, the de-SPACing vote is very challenging, and you got to have a lot of backup capital behind your SPAC to soak up all of the no votes from the arbitrageurs. And that ends up tying up the sellers who are selling to the SPAC for quite some time. So those are all very challenging set of factors for any seller, but for some it's right.
Yeah, I would say that in our experience, the redemption rates have been higher than what Herschel quoted. In fact, I mean, in some cases, 90%. And so it's incredibly challenging when you're effectively, you're either public or you're merging into a public entity with this capital, and if you make the mistake of issuing forward-looking guidance on a business model that incorporates the announced amount of capital that you think you're going to close on when the SPAC is announced, your business model is already flawed. And so as a result, if it's a $200 million SPAC and you only close on, 20 or 30 million of that, I mean, the model that you built doesn't work. And so you're playing catch up from the start, and there's companies in California right now, they'll go without being named, that are struggling with that mightily right now. And it's and I don't know how you ever get out of it, quite frankly.
So is that one of the reasons we see some very large pipes going in before the de-SPACing?
That's exactly right. Because but then again, you think about the redemption rates, but then you have the dilution that a pipe will cause. It's just it really makes the capital stack quite difficult from the get-go.
Well, you have to sell yourself to someone to someone like Fidelity to do the pipe, so you can get the deal done, get the votes, and get the capital, and get the deal done.
But at the end of the day, I mean, in our experience, everybody that's playing the SPAC world, which by the way, it's dried up a lot, they're just playing it for the yield. They have no interest in approving a deal. Sure. End of discussion.
They just want to strip the warrants and hold it.
I'm not as skeptical on SPAC. I mean, look, I get all your points. If you look at the parent company, they put $250 on the balance sheet. Even Glass House put over 150 million on the balance sheet. So look,
but it's still significantly less than what they had put out, and it affected their guidance 100%.
There's no doubt that was a 400. I mean, they're too big, right? So you really have to size. I mean, the SPAC should really be 150 or so for it. You really have to look at the investor pool, and there's some sponsors that'll backstop a lot of the redemption. So it's really dependent on looking at the shareholder base and really understanding what the redemption factor is and who's going to make up the difference related to a pipe. The only dilution you take on the pipe is related to the initial valuation. So the initial valuation we're seeing in IPOs is similar to private markets, where it's a 50% or so discount. So we generally look at 2022 and we take a 50% discount to EBITDA. So the market is clearly pricing on EBITDA today. I mean, Herb will try to go public with a 3% EBITDA margin. Not going to happen. Market is all EBITDA, and they want to see, high margins or as high as 20% plus at minimum. The SPAC vehicles, if you can get the capital on the balance sheet, we like it in the dense of large capital-intensive markets. So, it's great to buy a Florida license for $10, $15, $50 million, but it's going to cost you another $100 million to put the infrastructure in because you got to go vertical and you got to build out in order to be competitive. So in markets where you're going to need huge capital and we can have confidence in the SPAC vehicle based on the sponsors, that there'll be 50, 60, 70 million dollars there, we think it's a good vehicle to going public in order to have a pre-funded CapEx plan going forward.
I think what you're going to see is further regulation of the SPAC industry, a continuing difficult time. You only have, out of the 300 SPACs year to date, you have less than 5% that are trading over their $10 share value. So now you're starting to lose investor confidence when really the idea was to bring us back so that way it was a quick pop. So I think you're going to continue to see it under regulatory scrutiny moving forward, and other types of liquidity events or vehicles are going to be necessary because the investor is not aligned with the vehicle any longer. And Congress is starting to pick up on that, especially now that valuations are obviously changing. So,
and let's not forget one other thing. You still have the listing issue, which is if you were de-SPACing into a plant-touching entity in the U.S., you still can't list it on New York or NASDAQ. You got to take it to CSE. Even Toronto won't take it. You got to go to CSE. Very limited liquidity. Who knows if you're going to get that transaction approved if afterwards all I have is a CSE listing.
We're kind of beating a dead horse, but there's one last thing that's important, and that's you only have a certain amount of time to get a deal done.
right.
And all that capital has to be returned to the investors if you can't find that deal. So in some senses, you can make the argument that the acquirer is going to say, holy shit, we've got 5 days to go get an asset, let's just do a deal.
Right.
And I mean, it's a little bit of an exaggeration, but it's not far from the truth.
That's right.
Well, in closing, I'd like to thank our esteemed panelists. This has been a tremendous panel on behalf of Burns & Levinson. Thank you very much. I'd like to close with one final question. Bold key predictions for the next 5 years, SPACs or otherwise, and we can start with David and go on down the line.
I was going to say I'd like to buy a vowel, but I'll go. Descheduling is going to get pushed out much further than people think, and I think that's a huge positive for the industry.
I think we'll see some type of quasi-legalization in that period of time. It may not be anything major, but I think it'll be just enough to get institutional capital to enter the game in some form or fashion. And I'm of the belief that that's really, really important for the industry. I know there's a lot of people that get nervous about the smaller companies getting pushed aside, but the reality is that this is what could be an $80 billion business domestically, and you can't support that just in the capital that's out there right now. And so we need it. We need something to be that catalyst, and plus those of us that have been playing it a while want to make a little more money too. So
Absolutely.
I think you're going to start to see more of a public vehicle as the tax code changes to provide state tax credits, very similar to the historic brewery concept, that are going to help to fuel social equity because that's lagging. So in states like Massachusetts, you might get a state tax credit as being a part of that capital stack, which will attract further investment. And I think that that's the route that it's going to go.
Well, I'm still on my heels because you totally stole my thunder. I love that call on no federal legalization within the next 5 years. I really do think that is true. I do agree that we'll get some banking resolved in capital markets, but so I guess I'll go on the technology side of things. I think there are amazing technologies that are just being started today, addressing highly complex, fragmented industry that we have today. And so looking at some of the next largest tech companies being born in cannabis that will be servicing other much larger total addressable markets. But the ideas, the solutions will be created here. So thinking about companies like the next Amazons, Googles, yada, 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 born in cannabis.
I would foresee 5 years from now development of a robust derivatives market. Something no one's touched upon today, but you can easily foresee the need right now. Of course, it's very difficult to do right now. Maybe it'll be dealer to dealer or one-off transactions, but eventually there has to develop, for many different reasons, a derivative market in flower and cannabis and so forth. And yes, there's all different types and all different grades and all different qualities. Understand that, but same thing is true in oil. We all trade WTI, but there's very different types of oil that trade against WTI. So you could foresee eventually some sort of derivatives market for both, obviously, consumers as well as producers, which would add a lot of liquidity, add a lot of availability of capital to the industry.
Herschel?
Yeah, I think next 3 years you're going to see status quo. I don't think we'll see how 2022 comes together on Congress, but they can't even get infrastructure done. So I just don't see them moving the needle much for cannabis. I think you're going to see some more activity on the brand side, and I think you're going to see some high-profile individuals start deploying aggressively into the market. So, guys who have accumulated a large net worth, seeing the market and starting to deploy aggressively, and the large non-touching or LPs being a lot more creative with structures such as like Tilray coming into MedMen and other entities taking advantage of some complex structure.
Thank you very much. Thanks to the panel. Thanks for celebrating our 5-year anniversary with us. I think that's it. I don't think we have time for questions unless I get the thumbs up, thumbs down. So thank you very much, everyone. Thumbs up otherwise, though.
Thanks, guys. Enjoyed it. Yeah.
Enjoyed it.
Thank you.
Yeah.